Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retirees. In today's episode, we're going to talk about the Federal Reserve, some recent news, and why news about the Federal Reserve affects the stock market pretty much every time. So we'll talk about more on that just coming right up. As always, if you hear something in today's podcast that causes you to want to take some action or make some changes in your situation, please, before taking any action, understand that this podcast is not designed to be specific tax, legal, or investment advice. Should you hear something today that causes you to want to do something or take some action, well, we're certainly gratified by that. We must insist, of course, that you confer with the appropriate tax, legal, or investment professional prior to making any changes. Okay. From CNBC today, well, actually, this article is about 2 days old, but we had a special interview, for those of you who saw that, with Dr. Robert Pokorsky, and so that delayed doing this particular video and topic, but it is very common for us to see anytime news comes out from the Federal Reserve for markets to react and also the stock market to react. And so I want to discuss a little bit about why that happens. Now, in the most recent article from CNBC, this article is courtesy of Jeff Cox. Okay, so I've covered a few of Jeff's articles before. He does a pretty good job in covering, economic topics, and especially when the Federal Reserve is doing things. So we'll cover that article, but what he highlighted in his article is that the meeting minutes that were released from the Federal Reserve meeting in July indicated that the Federal Reserve was going to begin tapering its asset purchase program. Now, a lot of these words sometimes I feel like are used so that average people have no idea what that means. So I do want to kind of highlight what that means for you and what's being talked about here when we say an asset purchase program, and then also specifically a tapering of that program. So when the Federal Reserve System, the Federal Reserve is charged really with two major jobs. Number one is controlling inflation, and number two is controlling unemployment. So those are sort of the two big. Now it has a range of other responsibilities, but those other responsibilities all fall below job 1 and 2, which is controlling unemployment and controlling inflation. The Federal Reserve also has stepped into the role of effectively bailing out the stock market without congressional action being necessary. So if you remember back, you think back to the 2008 crisis, there was all this talk, there was a big push that Congress needed to act, right? We had to get a bill through Congress to get capital into the markets to help out the banks, prevent the economy from collapsing. Congress had to do something. Well, interestingly, we've had a couple of financial difficulties since then, but we were never waiting for Congress to take any big action. Why is that? Well, the Federal Reserve has found ways through its action to step in and take the actions that Congress either is unwilling to take or can't take. They're either not able or not willing to do it. Maybe in a lot of ways because of political reasons as well. It would not be very fiscally responsible for Congress to authorize the purchase of hundreds of billions of dollars in debt securities and mortgage-backed securities. That would be probably very frowned upon. Whereas if the Federal Reserve just does it and they call it something like quantitative easing or an asset purchase program, most people don't really know what that means, and it's a little more palatable to the general public. But that is what the Federal Reserve is doing and has been doing. And since the COVID pandemic, they've been doing it in a big way. And so the Federal Reserve is now talking about reducing that asset purchase program. And as soon as those meeting minutes were released and people saw that, the stock market reacted very negatively to it. Okay, the stock market had a pretty big decline over a couple of days since the meeting minutes were released. Now, what does the Federal Reserve have to do with the stock market? They're not buying stocks. So why is it that the Federal Reserve reducing their asset purchase program would cause the stock market to experience some difficulties? Well, one of the things that the Federal Reserve does have an impact on when it purchases mortgage-backed securities and treasury bonds is it does reduce the overall yields in the market, interest rates. And so as interest rates decline, when we see those interest rates come down, that encourages businesses to take on more risk. When you're talking about businesses developing new ventures or taking on risk, one of their benchmarks to measure risk in say, a venture that they don't know if it's going to pan out is by taking on some debt. So if a big company with a lot of cash flow takes on some debt to finance a project, a venture, a new potential business income stream, in order to take on that debt, they have to borrow money, and if interest rates are higher, that risk is more expensive. So effectively what the Federal Reserve does when it reduces interest rates is that it makes risk less expensive. Now it's not just new ventures, it's also existing businesses and existing cash flow and models and all of that. So you take a company that has a lot of employees, maybe an auto manufacturer would be a good example, maybe, manufacturing of any kind is a good example, because what we used to see a lot more of than what we see today are companies engaging in layoffs, right, where they lay off a bunch of their employees if the economy is taking a hit and risk is at a premium, risk is high. So with COVID creating a lot of uncertainty, what happens is companies are going to tend to lean towards laying off employees and reducing their workforce and pulling back on their business risk because it's uncertain times. They don't know what's coming down the road, and they want to make sure that their business survives. So that's what they would do. Now, if the Federal Reserve purchases treasury bonds and mortgage-backed securities, pushing down the risk of continuing business operations, then the companies are more likely to borrow money, borrow cash, borrow capital in order to be able to bring that into their balance sheet, continue to hang on to employees that maybe they're not using at full capacity right now. So essentially what you end up with is you end up with more dollars coming into the system via debt, okay, via risk. Okay, these companies are taking on the risk that their business will survive the pandemic, it'll survive into the next business cycle. And so they're going to take that risk, they borrow the capital to fund and pay for employees and expenditures and all of this. But here's the problem. They're doing that non-productively because it isn't as though they're just going to keep producing tons of product, okay? And in many cases we saw where a lot of work from home programs, people being reduced in their amount of hours that they're working. So they're now retaining employees. Those employees are being paid. Now we know that there were many layoffs, okay, mind you, but there are also companies that retained employees and retained operations at a reduced capacity. And so there again, we've reduced production, but increased the amount of capital relative to the amount of production being done. That's inflation. Okay, another reason, if you've watched a lot of my videos, you'll notice that I talk about dollars competing for goods and services, more dollars is going to increase the price of those goods and services. Now, we have a situation here with unemployment where if unemployment's very high, but we're paying those people being unemployed, non-productive people with the dollar still in hand, it's going to cause price inflation, fewer goods and services relative to the amount of dollars competing. Same thing happens with quantitative easing. Okay, we reduce the risk of companies to borrow cash. They borrow the cash, they maintain their employees, but production is down, fewer goods and services. We still have dollars competing for those goods and services, but it's a reduced amount, so we're going to see price inflation. And we've seen that across the board in so many different areas. And while some of that is coming a little bit more under control, it's still certainly a problem. And the Federal Reserve does not want to continue this inflation issue forever. Now, quantitative easing will increase interest rates, or decrease interest rates. If they pull back and stop doing the quantitative easing, then what we're going to see is interest rates start to climb back again. And these companies, these Fortune 500 companies, these companies in the S&P 500, the NASDAQ, the Dow, these are the companies that are using these low interest rates to buy back their own shares of stock. They're using it to fund new business ventures for mergers and acquisitions. They're doing it to grow their businesses. And so if the Federal Reserve, they don't have to raise interest rates for interest rates to go up. If they taper, okay, that's the phrase, if they taper their asset purchase program, it is likely to cause interest rates to rise. And when we see interest rates rise, then businesses are less likely to borrow. Risk is at a premium again. Okay, we start to pay more for taking on risk. And so we're going to see some of these businesses pull back in terms of some of their stock prices and things. Now, the market reacts to everything and often overreacts, right? So the Federal Reserve really hasn't done much yet. So why does the market react so quickly when nothing actually logistically has happened yet? Well, everyone is trying to get ahead of everything, okay? They don't want to be the last person to reduce their stock exposure. They want to be the first person to reduce their stock exposure. The problem is that there's this tension between what's really going on in the markets and what could happen in the future. And that tension point is what causes a lot of this volatility based on a piece of news. So when we see news about the Federal Reserve, because they're having such a big impact in our economy and in our stock market through the asset purchase program and the artificial reduction in interest rates, because of that amount of activity, we are seeing the effects in the markets. The effects in the markets will continue to be very volatile as people are trying to sort out just how much of an impact is the Federal Reserve's action going to have. And so it's hard to decipher exactly where this could go and how and what the timing will be. But we're going to see a lot of bouncing around, I would say. Don't be surprised if we see a lot more news about the Federal Reserve and a lot more reaction to it in the stock market. So this is something that you should look for. It's something that you should expect. How should you react to it? Kind of depends on your specific situation and where you're at in things like your retirement time horizon and those sorts of things. But you obviously should confer with the appropriate investment professional to discuss those issues and decide a strategy for how you're going to react to them. Okay, as always, we'll link the article from CNBC. I'm also going to link another article that does a more deep dive into the asset purchase program and how it works and what tapering means, and that's from the Brookings Institute. So I'll link both of those articles in the description section. As always, we encourage you to follow our Facebook page, subscribe to our YouTube channel, and we'll look forward to seeing you next time.